Hello and welcome to today's episode of The Talking Point. The talking point today, in a scenario like this, is obviously what's the best way to invest through this crisis. So the market reaction doesn't quite seem to suggest that this is a crisis of late, but there are various ways to skin a cat, isn't it? I mean, how to identify winners. I think a lot of people will tell you that avoid the disrupted FY21 earnings and look at normalized earnings growth for FY20 to FY23 onwards. If you can indeed look that far out, and if you can indeed hold your positions that far out. One way to do it would be to analyze the attractiveness of the portfolio companies on a bottom-up basis and compare it to the macro situation. And if the valuations don't look terribly expensive, then it's never a bad idea to do that. And of course, asset allocate very prudently and avoid risky bets. Well, Marcellus Investment believes that consistent compounders are the best bet in a crisis situation. So, what are these consistent compounders? How to identify them? Here's Saurabh Mukherjea with some of those thoughts. And what I'll try and do during the next half an hour is try and play the devil's advocate and point out questions to almost all of these assumptions that Saurabh might have as well. Saurabh, really good having you. Thanks so much for joining in. And it's a very interesting blog that you guys have written. So, viewers, I urge all of you to read through it as well.
Thank you. Thanks for having us on this.
Pleasure, Saurabh. Saurabh, just before we get to that conversation about how to invest through the crisis, just a quick reaction. Has this up move surprised you? Though I must admit that you were amongst the few ones who said that you believe that it might be worth buying because of the potent combination of two or three factors back then when we were at about 8,000. What's your feeling now?
So look, I think from the middle of March, we realized that the market had overdone the fear. So if you look by the end of March, I think the Nifty, Sensex both were down around 35% between Jan, Feb, March, and that obviously made no sense, right? If the market falls 35%, it suggests that the next 4-5 years of profits are wiped out. And however serious COVID was going to be, I don't think anybody in their right mind believed or believes that 4-5 years of profits going to get wiped out. So by the end of March, we were pretty convinced that there was a real opportunity from the fear, from the dislocation and the panic in the market, and hence we're not surprised to see the relief rally gradually coming back as the world comes out of the lockdown. We will see a little bit more of this relief rally, I suspect, through June, July. But I think we should also be prepared for people overreacting to good news, right? So what will happen is as we come out of the lockdown, there will be pent-up demand that will come through. And I almost guarantee you there'll be people who will overreact to that saying, my God, look, things have recovered so quickly, V-shaped recovery and all of that hype. And then obviously through August, September, as the pent-up demand exacerbates, there'll be a wave of, I think, depression as well. So there you will see this sort of volatility. I would say ignore it. Focus on, as you just mentioned, focus on great companies, high-quality compounders, clean accounts, strong franchises, if you want to have a steady ride through what will be, I think, a turbulent few months for our stock market and for our country.
So how do you advocate, Saurabh, when you are identifying these consistent compounders? What is it that you go through? Or what are the factors that you take into consideration? Sure, it's a long list, but let's get started.
So I think it's three things. It's actually not that long a list. It's actually three things, and we've done this for a long time. The first thing is you look for clean accounts, right? Very few companies, very few listed companies in our country are publishing bona fide, believable numbers, right? And I've said this repeatedly. I would suspect something around 70 to 80% of listed companies, the books have some measure of accounting shenanigans in them, and therefore step one is to look for companies who are publishing clean accounts, believable numbers. In the BSE 500, I would say the list is as short as 70, 80 companies. Step two is to look for companies which are selling essential products, stuff that all of us buy every single day, whether it's through the lockdown, through a boom, right? Things like baby milk powder, footwear, adhesives, undergarments, basic essential stuff that we need to live ordinary lives. And the third thing, perhaps the hardest thing, is very high barriers to entry, which is similar to prudent capital allocation. You want to invest in companies who do not have to fight it out in a competitive market on a daily basis. If you invest in companies who are in intensely competitive markets, say such as airlines, such as telecom, such as NBFCs, you invest in such intensely competitive markets, very high for the company to generate a high return on capital employed. So look for companies with ROC well above cost of capital. That necessarily means high barriers to entry, clean accounts, and essential products. If you're able to lock these three together, you get a portfolio which makes you money through disasters, pandemics like COVID, through difficult economic circumstances, and also makes you good returns even if the economy booms, even if we have, say, a year like 2017 where the market roars into life.
Hmm. Okay, so let's talk about some of these characteristics individually as well. Saurabh, you've laid in that blog of yours and even in conversations very high importance to the return on capital employed or ROE. Now, can you dwell a bit upon this? And I'm sure that is not, it's a necessary condition, but not a sufficient one.
Yeah. So I think in effect, what great companies do, and it's what makes them special, but it's also very hard to do. What great companies do is generate a return on capital well above cost of capital, right? So the spread between return on capital and cost of capital, the spread is free cash flow, right? This is the basic measure of corporate success. Is my business generating free cash flow? The way we measure ourselves in Marcellus is Marcellus generating free cash flow? Are those companies on the screen, as Marico, as Pidilite, are they generating free cash flow? So the basic measure of a company's success is your return on capital above cost of capital. The delta is free cash flow, right? That's the money which a company is generating. That's what you and I are paying for when we are buying the stock price. You'll be astonished to hear that out of the Nifty 50, 70% haven't generated free cash flow in the last 10 years, right? And yet, people go out there and buy these stocks every day. It astonishes me, but it also allows us to earn a good living in Marcellus because the market is so irrational. The market pays for companies that don't generate free cash flow. So step one, generate free cash flow, the delta between return on capital and cost of capital. The next part, which is equally hard, reinvest the vast majority of the free cash flow back in the business, right? So reinvest 2/3 of the free cash flow, 3/4 of the free cash flow back in the business so that you can grow the business further. What companies like on that screen, I saw Pidilite, what a company like Pidilite excels at is its free cash flow will be around 25 to 30% of capital employed, which is an immensely high number, and it will then reinvest 2/3 of that. So every year, a Pidilite or an Asian Paints will reinvest 20% of capital employed. And as you reinvest 20% of capital employed, by definition, almost the business doubles every 3 to 4 years, right? If you keep adding 20% to your capital base, every 3 to 4 years your business doubles. You keep doing that year after year. In a given 10-year period, you'll generate around 20 to 25% compounding, right? It's very simple to describe to you, but it's very, very hard to do. Very high ROCs leading to very high free cash flows. That in turn being reinvested, you're doubling the size of the profits every 3-4 years. You're doing this decade after decade. It's basically the Premier League, the IPL of corporate life, right? This is where the elite play. You and I want to make money from them. We want to invest in India's elite companies. Disclaimer, Pidilite, Asian Paints, these sorts of firms are part of our portfolio. And that's how we earn a living and augment our clients' wealth.
Okay, and I'll get to maybe some of these individual things as well. There are case studies which are very interesting, but just that table which speaks about the consistent compounders or companies which have dominated the Indian landscape. And I think the Marcellus blog seems to suggest that some of these have been dominant firms for the last 15, 20 years, and all of them have that one unique trade running through them is the kind of return on capital employed that they have done. The interesting bit, Saurabh, in that conversation was, or in the note of yours was, or the blog of yours is, that higher ROC need not be a sufficient condition. I think you're probably highlighting Maruti, right? Because it's an industry dominant firm, but the ROC is not necessarily been the standout trait. So can you dwell a bit on that as well?
Sure. So I think this is a super point you've raised. So a lot of people in our country get a little carried away when they see high ROC by itself. So for example, you take HUL, you take Castrol, right? Take Colgate Palmolive. These are all companies with very high ROCs, anywhere between 70 to 110% ROC, far higher, ironically, than a Pidilite, right? Yet these companies, compounding engines, function at, say, half the speed of Pidilite's compounding engine. Someone like a Pidilite, an Asian Paints, the compounding engine fires at around 20-25%. That's the sort of money you end up making on these companies if you stay invested on for long periods of time. But a Castrol, a Unilever, a Colgate Palmolive, their compounding engines don't function even at 10%, right? Why don't the compounding engines of these three high ROC companies function at high speed? Because the reinvestments of surplus capital is actually quite low. So there are high ROC companies, and these are great franchises. I mean, Unilever, Castrol, Colgate Palmolive, outstanding franchises, very high ROC, but the reinvesting barely a quarter to 20% of capital employed. Sometimes not even that. They're giving out very hefty dividends. So dividends will be anywhere between 2/3 to 80% of capital, or 2/3 to 80% of free cash flow for these firms. Great if you like dividends, but your compounding engine is not moving very fast because your reinvestment is relatively low, right? So the hard part is not just high ROC. It's the high ROC combined with high reinvestment of the surplus capital. To do the two together is basically to become a Virat Kohli of the investment world. Virat Kohli is scoring at an average of 52, 53 in one-day cricket at a strike rate of 90, 92. Right? That's hard. To score at a good average is doable. To have a high strike rate is doable. To have a high strike rate and a high average, that is the domain of the legends. And what Virat Kohli does in cricket, the Pidilites and the Asian Paints do in the corporate world, very hard to do.
So you reckon this difference is because of the nature of the business or the management strategy or a combination of a few factors?
Yeah. So this is where it gets tough, and this is where it gets very interesting. So far, everything I told you is very sort of number driven. You're looking for high ROCs, you're looking for reinvestment surplus capital. The hard part is to figure out why is it that, I would say no more than 20 companies in India are able to pull it off. In the BSE 500, only 20 companies are able to pull it off. Why can't the other 480 do it, right? And as you suggested, it's a mixture, right? Some companies have built management teams and have built franchises which are constantly able to discover new opportunities and find new areas for investment. So just to stick to Pidilite as an example, Pidilite started out in the 70s and 80s as a adhesives monopoly, right? Around the turn of the century, they got into waterproofing, and now Pidilite is a double monopoly: adhesives 90% market share, waterproofing 90% market share, right? So they reinvested surplus capital from adhesives to become a waterproofing monopoly. And now, as we speak, and you showed some of the acquisitions on the screen, if you see the last couple of years of Pidilite's annual reports, they're now building monopoly number 3, right? By buying these sorts of firms, Pidilite is basically entering specialist areas, specialist flooring, specialist type of chemicals. So they're now using niche acquisitions to build, I would say, monopoly number 3, which is becoming an essential part of the interiors of our house, with different types of specialist flooring. So Pidilite is a great example of taking surplus capital and moving into adjacencies to build monopoly after monopoly. This is very hard to do. And as a result, no more than 20 companies in the BSE 500 pull it off. Most class companies, most really high class franchises tend to be a little bit like Castrol and Colgate, where they've done one thing really well: Castrol lubricants, Colgate toothpaste. They have a complete hammerlock on that sector, lubricants and toothpaste respectively. As a result, their ROC is very high, but they're not able to figure out how to redeploy that surplus capital to grow the franchise at a good clip. And as a result, shareholder returns are solid, 10%, 11, 12%, nothing to sneeze at, but it's not a 20% compounder.
So, Saurabh, just 2 follow-ups. One, when you invest in these companies, and let's say any of these companies, let's say Pidilite or an Asian Paints, if they are moving capital into a new stream or a new venture or an allied venture as it may be, it is still an unproven ground, right? So therefore, constant monitoring of how the new venture has done as well must become equally crucial in such a scenario.
I think it's a combination of that and one other thing. So our job as a fund manager, actually, believe it or not, is not to check the PE multiple and what has the Sensex done that day. That actually doesn't really generate any value for our clients. Our job as investment managers is to look at 2 things. One is to look at, say, the capital allocation calls, just to stick to Pidilite, to look at the capital allocation calls the Pidilite promoters have made over the last 20 years, right? Read their annual reports, sit down with the management team, look at the reinvestment of surplus cash flow, and see over time, have they got 2/3 of their calls right? Nobody's expected to be a genius. You will make some mistakes, like everybody else. Pidilite made a mistake back in 08, 09. But if you get 2/3 of your capital allocation calls right, we take a lot of comfort that you've got this innate skill figured out of how to reinvest surplus cash flow. And the second is to understand using using the last couple of years of annual reports, management conference calls, transcripts for management's quarterly calls. Where are they now taking the franchise? Where will they allocate surplus capital, right? So, for instance, if you see ITC's last couple of conference calls, very interesting, right? They have stepped up the payout, the dividend payout. They've taken it from 60 to 85%. That's ITC is telling you, I will pay out the bulk of my profits to you because I already have 30,000 crores of cash on my balance sheet. And then you saw ITC recently making an FMCG acquisition and suggesting, and their CEO is suggesting that there's more such to come as they try to ramp up the FMCG business, right? Now, it's incumbent on us to figure out, can ITC's ROC pump upwards towards 50%, given the strength of this company in allocating surplus capital? And this is what makes the job interesting. You look back at the last 20 years, make a judgment call on, does this promoter, does this CEO know how to allocate capital? If he doesn't, you move on. And if he's done it historically, you keep track on him and make sure that going forward, he doesn't screw it up, right? And that's what makes the job interesting. That's how we are able to be useful to investors out there. It's not by looking at the PE multiple or gyrating with the Sensex that we can actually add any value to the client.
I have a question, and I'm not asking you to make me a recommendation out here, Saurabh, but
Right.
just wondering. Yeah, there was a note that I found merit in some of the arguments. Goldman recently came out with a note on Asian Paints. Now, one can argue with the logic, the target price. I'm not getting into that, but I'm asking you that here are some companies that are priced richly. I know you don't look at PE, but I'm still asking you from somebody who's trying to make an entry point here or something like that. The franchises, some of them are valued richly. There is a higher probability of some bit of down trading likely in the Indian landscape over the next 6 to 9 odd months because there have been job losses, salary cuts, etc. Right? Why would say an Asian Paints or some of the other franchisees manage to continue to trade at these valuations if indeed earnings are likely to see a bit of a beating for the next 6 to 9 odd months?
Sure. So I think it's a very good point. And whilst I have to confess, I'm not that much of a reader of broker research, but it's a point well made. We're in a difficult circumstance. The economy is obviously struggling, and why should anybody invest in Asian Paints or Pidilite or Relaxo or indeed in any of the other stocks that we hold? I think what's worth realizing is that these franchises that I just mentioned, they've endured for 40, 50 years. They've compounded at 24, 25% at a pretty steady rate over the last 40, 50 years, right? So if let's take, since you mentioned Asian Paints, out of the last 20 years, Asian Paints has delivered 20% plus returns in 13 out of the 20 years. HDFC Bank has done 14 out of the 20 years. Someone like Pidilite has delivered 20% plus returns in 11 out of the last 20 years. And all three companies I just mentioned, Asian Paints, HDFC Bank, and Pidilite, they've never given a negative return when the market's given a positive return in the last 20 years, right? So these are remarkable franchises. Very rarely do they fail to give you 20%, and they've never given in the last 20 years negative returns if the market has given positive returns, right? Now, why is it that they can do this, right? So everybody out there is entitled to their opinion on what will happen to Asian Paints and Pidilite in the next 3-4 months. But our job is to figure out in Marcellus, how come Asian Paints, which is a massive franchise, right? 55% of the paint market. How come Asian Paints simply does not disappoint, right? And the answer lies in this case in the spread of what this company says, right? They're selling something like 5,000 plus SKUs. Their cheapest paints, the cheapest products will be around 25-30 rupees a liter, right? It will cater to the economy segment. And their most expensive products will cater to the people who are watching this program at say 800-900 rupees a liter, right? So Asian Paints has by design created a franchise which spans the entire spectrum from bilkul budget products to the highest end of luxury, right? And by doing so, they have made sure that whatever the economic circumstance, the business comes to them. The second thing Asian Paints has done, and you've seen this in work over the last 3-4 weeks, spectacularly seen this at work over the last 3-4 weeks, is they've consistently helped their distribution channel in times of distress like demon, like say the GST transition or the current COVID aftermath. So as you might have heard, 3 weeks ago, 4 weeks ago, Asian Paints wrote to all their distributors and they told the stock market about it, that they're putting 600 crores of cash in distributors as bank balances, bank accounts, so that the distributors are able to deal with COVID without pain. Right now, there are very few paint companies which will be able to do this, and therefore, once the channel reopens, once the paint shops reopen, it doesn't take too much brains to figure out whose paints will sell, and whose paints won't sell. So it's a combination of a company which has got a product range which spans the entire spectrum with enormous financial strength at 40% ROC, which allows them to support distributors in some of the most dire circumstances you and I would have seen in our lives. Very few companies have that ability, which is why you get evergreen compounding, you get all-weather compounding from an HDFC Bank, a Pidilite, or an Asian Paints.
Okay, we can go on because there would be a lot of points to discuss, but I want to move on to the other things for a portfolio characteristics, Saurabh. I mean, multiple questions on Asian Paints, Pidilite, or franchises, but let's not make it a stock-specific conversation. One point that you mentioned in the blog as well, for an ideal portfolio to compound well, is less than ideal percentage allocation in the portfolio, which hurts. Now, dwell a bit on this. I mean, when you are looking at these, for lack of a better word, tiger franchises, what kind of allocation do you look at when you're making these allocations, and how much do you ramp it up to? Let's say you're convinced about a winner. What kind of ramp up do you do to an individual stock in your portfolio?
So one thing which has perplexed us for a long, long time, right? I've been living in India for 12 years. I've seen, because of obvious reasons, I've seen hundreds of Indian portfolios. I've never quite understood why so many fund managers in India run portfolios with 30, 40, 50, 60, 70 stocks, right? Because once you have a portfolio as distributed as that, even if you get a few of your stock picks right, you'll struggle to deliver benefits to your client because your portfolio is so dispersed. So the house philosophy we have followed is 13 to 15 stocks, 15 at most, and 13 at least. So 13 to 15 stocks. And within this, the top 4 stocks typically will have 10% plus weight. So the top 4 stocks together will typically form around 45% of Marcellus's portfolio. Now, how do we decide which 4 will be top 4? The 13 to 15 I've described so far: clean accounts, essential products, high barriers to entry, which is same as saying high ROC. But within that, we sit down as a group and say, amongst these 13, 14, 15, where do we have the greatest clarity that the barriers to entry are incredibly high, where the competition simply is not in the same ballpark as this company, and hence we can take a outsized position. So in Asian Paints, you won't be surprised to hear, is an outsized position. North of 10% of our portfolio will be in Asian Paints. Similarly, in HDFC Bank, I'm sure many of your viewers won't be surprised to hear, is an outsized position. So the call we are making is step 1. We want to see the 3 boxes ticked: clean accounts, essential products, and high barriers to entry. And then for figuring out where to disproportionately allocate money, we need high levels of proof that the barriers to entry for said franchise are so high that the rest of the competition is not really operating in the same ballpark. So if let's take HDFC Bank. In HDFC Bank's case, the CASA franchise functions at a different level of efficiency to I think any other bank in our country, right? If you take the CASA franchise, they're consistently able to have 40, 42, 43% CASA, whilst only paying 4% on the SA. Whilst only paying 4% of the SA. We also have Kotak Bank in the portfolio. Kotak does have 50 to 53% CASA, but Kotak has offered consistently 6% for the SA, the savings accounts. So HDFC Bank what they've built is a low-cost funding machine, which at around 4.5, 4.6% cost of funds is getting money. And then even if he lends to people like you and me at 9%, they're taking home 450 bips of NIM with low credit cost, right? That then becomes the HDFC Bank compounding engine. Very hard to dislodge that. So the trickier part is the disproportionate allocation of our portfolio. Around 45% of our portfolio will go to the top 4 stocks. It obviously means that we're going to get our judgment calls right on those. But it also means that we stay focused on those 4 or 5 judgment calls, and the team's disproportionate research effort goes to 4 or 5.
Okay, I get the point. So that's the call, but I also got some answers which you didn't quite explicitly say, but portfolio allocations need not necessarily go 15-20% in a single stock. You kind of restrict it to about 10-12% maybe, and then disproportionate research there. Okay. The other
That's
point
right.
that you brought out, Saurabh, is at times people not holding on a stock for an ideal period of time. Can you dwell a bit upon that? I mean, because I'm guessing that you were trying to say that you
It's a
hold on to
super point.
stocks for a really long time.
Yeah, so it's a super point. So one of the most fascinating things about great compounders in India, and let's take all of these companies whose names I've given you: Kotak, Asian Paints, ITC, HDFC Bank, Pidilite, right? In a 10-year period, 5.5, sometimes 6 years, they don't compound very much. And then in 4 to 5 years, they give you your 10x in 10 years, right? So 4 to 5 years, they compound at such a frenetic rate that you get 10x in 10 years. But 4, 5, sometimes 6 years, they won't give you meaningful compounding, right? And obviously, the temptation is to sell and run away. I'll give you even a further bit of bad news. Those 5 to 6 years of weak compounding are not back to back, and the 4 years of great compounding are not back to back. So Asian Paints will have 2 years of weak compounding, and then 6 months of frenetic compounding, 2 years of weak compounding, and a year of super compounding. Ditto with an ITC, ditto with a Kotak Bank. Now, where I find a lot of investors quite delusional is their belief that they can time this. A lot of people honestly wake up in the morning and they believe they can figure out when I will exit Asian Paints and when I will enter. It's like almost as if they believe there'll be a providential sort of message from the big man in the sky who will say, now Asian Paints is the right valuation for you, please enter. Right? And we've shown in our work that it doesn't work. So, for example, if you or I put 100 rupees in Asian Paints every year on 1st January, right? So let's say you're the sensible investor. Every year you take $100 and you put it in Asian Paints. Had you done that over the last 10 years, your IRR would be around 27%, right? XIRR would be around 27%. Every year, $100 you're putting in on 1st January. But I rock up and say, look, I'm the fund manager. Give me your $100. I will time your entry in Asian Paints. I will figure out which day of the year we should buy Asian Paints. And suppose I do that over the last 10 years, this is hard data, I will outperform you just by 1 percentage point, right? That will be the value of my market time. The reason is the franchise compounds at 25% anyway. Whether you get in slightly cheaper, whether you get slightly expensive, it doesn't matter so much because the compounding slope itself is so punchy, right? Right? And now, if I try to time that, it doesn't make any sense. And then, hence, our point of view is on stocks of this quality, in HDFC Bank, Pidilite, and Asian Paints, we simply cannot time it. A lot of investors like to time it, and we say that, look, if you're free to do it, we don't have that skill set.
Okay. Saurabh, it's close to about 10. I have one final question. We've discussed your portfolio characteristics quite a bit. I'm intrigued and interested in knowing if you believe COVID-19 has thrown up newer investment opportunities or things that you did not foresee happening to have happened, and you've had to or you wanted to take a look at them, be it supply chain disruptions and therefore newer things being made in India, be it the advent of specialty chemicals in a proper fashion or pharma resurgence of sorts or something else, what have you. I'm not putting words in your mouth, but is there anything that you think you had not thought of 3-4 months back, but COVID-19 has made you realize, okay, let me look at it because it seems like an opportunity?
I think what it certainly has done, right, is it's accentuated the trend that we were seeing in the wake of Demon GST, which is that in all the sectors where the products are mass market B2C products, the regional players, the smaller players, were struggling to cope with the sheer muscle of an Asian Paints, a Pidilite, an ITC. Right, they were struggling as it is because they were regional players. They were having to now compete for the first time on a pan-India basis with extremely efficient, capital-rich companies. That was a trend as it is that was there. From everything that we are seeing over the last months of channel checks, when we are calling up distributors, dealers, it's relatively clear that the giants have got even stronger. So, for example, we did a channel check. We did some channel checks last week on Nestle, which is also in our portfolio, and it's astonishing what we are hearing from the channel is pretty much 80% of the Nestle's products are back on the market. Revenues are 80 pushing towards 90% of what they were in normal circumstances, and a lot of distributors and dealers are saying a persistent issue is we need even more Maggie and we need even more baby milk powder in our channel. This is a company whose products are utterly dominant, and obviously if you're a smaller supplier, smaller competitor to Nestle, life has become even more difficult in the wake of the disruptions posed by COVID. So as it is, we were gravitating towards becoming a country, we highlighted this in a blog a couple of weeks back, that the top 20 profit generators in India now take home 70% of India's profits. Back in 1990, the top 20 profit generators only took home 15% of India's profits. 15 say we've come to 70% of India's profits going to 20 companies. This trend will only accelerate. And by the time you and I are done with our careers, I suspect 15 companies will take home 85% of India's profits. That obviously should focus everybody's minds on having these 15 stocks in your portfolio. If you don't have these 15 stocks in your portfolio, it's not going to matter what GDP growth is. You're simply not going to make any money out of your investment portfolio.
Fascinating insights, Saurabh. Thank you so much for taking the time out and speaking to us today on how to invest through the COVID-19 crisis, any crisis. Really appreciate your time.
Thanks a lot. Take care. Have a good week.
Yeah, you too. Viewers, remember, this is not the be-all and end-all. There might be, 15 companies, and you might have 3 or 4 or 5 of these winners, but it might be important to look at the characteristics that Saurabh was talking about. Thanks for tuning into this broadcast.